As we've been discussing, investors are looking ahead to Fed Chair Jay Powell's Jackson Hole speech in Wyoming on Friday. Our next guest does say that U.S. stocks might have more room to bottom as the central bank interest rate hiking cycle continues. Mark Mobius, co-founder of Mobius Capital Partners, joins us now. Mark, great to catch up with you and get some time with you. I do, of course, want to talk in a moment about emerging markets, which has been your bread and butter for a long time. But let's talk about the U.S. first and what you think maybe the markets here are getting wrong, perhaps, about the Fed. What do you think?
Well, I think, first of all, there's a lot of confusion because on the one hand, consumer confidence is very, very low, as indicated by the surveys, but spending is high. People continue to spend. So the economists are really confused. And I think at Jackson Hole, they'll probably be talking about that extensively. But the bottom line is that it's not only about interest rate hikes, but it's about many, many other factors, such as shortages of water in various parts of the world, the drought, problems in China with the property market. And generally, China is a driver to some extent of global trade. So if China goes down, then it affects the global situation. Just like when the U.S. goes down, the situation globally is not good. So there's so many other factors. And of course, you add to that Ukraine. So there's a lot of uncertainty out there. But added to that, of course, is the expected interest rate hikes. And as I said before, we're definitely going to get much, much higher interest rates going forward.
Okay, and so let's stick with China for a hot second there, because we've already seen some of the GDP expectations in the region be lowered. Where do you believe that the real reading is as of right now, especially considering some of the steps that China is going to be taking? The PBOC already with the interest rate action to try and jumpstart any spending by the consumers and this consumer mindset, perhaps, that it is safe to go out and spend.
The interest rate declines that Chinese government is now implementing will help to some extent. But you must remember that the housing market is the key. Mm-hmm. Currently, as you know, there's been quite a disaster in many of these big property companies in China. And the Chinese believe in property. They believe in keeping their savings in property. So when the housing market is not good, when property prices are not doing well, they lose confidence. So, of course, the Chinese government is trying to counter that, but it remains to be seen whether they'll be successful. Because added to that, of course, are drought conditions now hitting China. And, of course, the crackdown on COVID, the COVID restrictions are having a big impact on many, many factories in China. Many of them have had to close down for a shortage of workers in the factories. So this is a complex of factors which is not good for China.
Mark, given those disasters in China and rising interest rates in the U.S., do you think U.S. markets, U.S. stock markets have bottomed for this year?
I don't think so. I think we probably have more to go, because if you consider all these factors I've been talking about, and of course, markedly higher interest rates, which will affect the U.S. housing market, of course, mortgage lending, as you know, is in trouble. So these combination of factors will probably have a downward impact on the market. But of course, it's anyone's guess. But my guess is that we probably see more downside going forward.
Mark, what do you think is the best or perhaps most overlooked opportunity globally right now?
Well, we're very big on India. We think India is going to do very well going forward. Young population, very English literate, and among the people, they are exporting lots of software around the world. Now they're getting into hardware manufacturing in a bigger way. So this combination of factors is going to be very good for India. So that my bet is on India at this stage of the game.
Even as we are here in the U.S. waiting for, of course, this Jackson Hole symposium and the Fed policy that the markets have been so active off of as well. Are you anticipating any type of pivot from the Fed, and what are your expectations even going into this meeting, and how people should position their portfolio?
I think the only pivot they can move into is higher interest rates, because the playbook for central banks, as you know, to combat inflation is to raise interest rates. And inflation in America has come down a little bit, but not as much as they would want. So I think interest rates will continue to rise.
Mark, do you think the Fed will be able to engineer a soft landing?
I think it's going to be very, very difficult because of the other factors that I've talked about. You have a complex of factors, and they can't, they can't put all these balls in the air at once. So I think it'll be extremely difficult for them to do that. But of course, they're certainly going to try. And it's going to be interesting to see how they manipulate interest rates and money supply generally. But you see, they've gotten themselves into this incredible hole with this huge increase in money supply that we've had in the last few years. And it's very, very difficult to get out of that.
And also, I would imagine there's an effect from what they're doing here across the globe, right? We have a number of central banks that are in tightening mode right now. The Fed certainly is in a bit of a pickle when it comes to it, but one could argue that there are other central banks that maybe even have it worse right now. So are there places you would sort of avoid based on the central bank strategies?
Generally speaking, I would avoid Europe. As you know, the euro has declined below the unbelievable number one, and that's quite a big move when you consider that euro had been so strong for so long. And of course, with Ukraine, with all the other factors hitting Europe, and of course, don't forget, Europe is just beginning to now tighten to the degree which they are required to do so in order to contain inflation. And then, of course, they've got real fuel problems. You must remember, at the end of the day, inflation is motored by fuel prices. In the U.S. and globally, this is the case. Now, the U.S., by releasing strategic oil supplies, has helped the situation to some extent. And you can see that gasoline prices are down, but not down as much as they probably should be. So in Europe, they're just facing this in a big way. There'll be big shortages of fuel, and that'll drive prices up.
Mark, I understand you're coming to us from New Orleans, Louisiana, so you got to have some beignets for us today. Mobius Capital Partners, co-founder Mark Mobius, we appreciate the time.